Over the last month, every video in your feed has been telling you the same story, but the great rotation narrative is a trap. You're being told that Wall Street is ditching big tech, fleeing the AI trade and running for safety in value stocks. It makes for a great headline, but it's completely missing how the next phase of this market actually works. The media screams about a rotation like it's a decision you need to make this week, but they never give you the time frame. Yet, they have you feeling like you already missed the exit. What they're calling a permanent exit from tech is actually just a brutal violent shakeout that wiped over $1 trillion of semiconductors in July, and everyone who panicked called it a bubble pop right before the floor held. The baseline run where everything spikes together is over, but the transition coming next isn't an exit door, it's an engine shift. So by the end of this video, we're going to strip away the panic, expose the obvious overlooked opportunities left behind, and lay out the precise invalidation levels where this whole thesis breaks, so you know the exact line in the sand. Because no matter how good the story is, nothing is ever a guarantee in the market, and you must protect yourself. Now, to be fair, the great rotation story isn't invented from nothing. Value stocks really have beaten growth stocks this year, by double digits on some measures. And this isn't some fringe call. Morgan Stanley itself has been telling clients to move out money of mega cap tech and into the rest of the market. The S&P's own forward earnings multiple has already come down from 22 times to 19. So when the media tells you the great rotation is here, they're not lying to you. But here's what's actually missing from all of it. The time frame. AI is over, the bubble popped, rotation is here, repeated like settled facts, like something with a start date, except no one ever gives you one. What they're really describing is a shift that plays out over years, not a decision you need to make this week, and that's the trap. Not that the rotation is fake, but that the one piece of information you'd actually need to act on it is the piece nobody hands you. Here's what actually shows up once you look past the headlines. Semiconductor companies aren't just keeping pace with the rest of the market, they're carrying it. The sector posted earnings growth of around 133% last quarter, and alone accounted for close to half of S&P 500's total earnings gains. And you can see exactly what that looks like in the name already at the center of this story. Nvidia's data center revenue grew 92% year over year last quarter. It's not an outlier, it's a pattern for the whole sector. The money behind it isn't slowing either. If AI spending were actually cooling the way your feed says, hyperscalers would be pulling capex back. Instead, they raised it mid-year, and the four biggest hyperscalers are now guiding to roughly $725 billion in combined capex this year, up about 77% from last year. That's happening in real time on earnings calls while you're being told the money's already gone. And even the physical supply chain backs it up. The specialized memory these chips depend on is essentially sold out into 2027. You can't manufacture a shortage that real out of sentiment. So if earnings are exploding and money's still pouring in, what actually changed? Not the opportunity. No, the participants in it. The move that took chip stocks from ignored to the most valuable companies on earth pulled almost an entire sector up with it, a rising tide. But the next leg doesn't have to work that way. We can already see it. Memory is probably the clearest example here. Some of those names already ran so hard that they may not even set new highs in this particular move. Not right away. That's not a bear case on memory, it's not an avoided label. It just may need more time to build before it's ready to run again. At least in the same degree that we have gotten used to. So in this entire story, while everyone is looking for the next rally in the memory sector, or the next hot thing in the semiconductor trade, most are missing the most obvious pick intentionally. It's being written off as already priced for perfection, but it's actually the one that shows the most clear conviction to be had for the next leg up, and that's Nvidia. Its own guidance for this quarter sits at $91 billion. Wall Street's estimates are already calling for something closer to $93 or $95 billion. Before the company even reports on August 26th, the street already expects it to beat its own number. That's not what a stock at the end of its story looks like, and the product cycle underneath it isn't slowing down either. The new Rubin platform is built to compete on the exact thing custom chips are supposed to win: inference cost, with Nvidia's own numbers claiming up to 10 times lower cost per token than the last generation. If that holds in production, it undercuts the entire ASICs are eating Nvidia's launch premise. So what you actually have is a company trading in the low 20s on next year's expected earnings, well below its own historical norms, guided conservatively enough that the street already expects it to beat, walking into a product cycle built to defend the exact narrative it's under attack for. That's not priced for perfection, that's priced for doubt, while the business keeps proving the doubt wrong. And this is probably one of the most compelling structures we have in the entire market right now. We are looking at what could be a double 1-2 setup, which means we now expect a 3-wave correction into this white area of support, and from these levels we expect the extension to new all-time highs to occur, where the ideal target for the larger wave 3 is right around $314, right? That is how much we expect for this larger wave 3 to achieve. It could do more, but that is the general area we are looking for. Two key things to notice here, however. This wave 1, there's no confirmation that the top is in yet. It could very easily extend higher, we see no meaningful retracement yet, in which case the area of support would shift slightly higher. And as a bonus here, if it does extend higher, it is quite likely it will top within the red dashed line region, around $232. We have some structural resistance exactly in this area. Then the second point, the invalidation. If this structure breaks down and pushes below the beginning of this entire wave 1, which is right around $190, the setup has failed. This will no longer work. There are interpretations that would fit this scenario, but we are looking at an enormous difference in terms of potential gain compared to potential loss. If the stock price is sitting right around $210, let's say, we would be looking at an invalidation at $190, while looking to potentially gain close to 50% in this entire move up. And that close to 10% loss is assuming you allow the full formal invalidation to take place, because if it gets a sustained break below the 78.6% retracement, around $197, the highest likelihood is that this structure will end up failing. You do not necessarily need to wait for the $190 break, although that is the formal invalidation. Now, zoom out from that chart for a second, because there's a name hiding inside Nvidia's own hardware that almost nobody thinks of as an AI stock. Every Grace, every VR CPU sitting next to Nvidia's GPU is built on ARM's architecture. Nvidia actually tried to buy ARM outright back in 2021. That's how much Nvidia believed in the potential of this company. And it's not just Nvidia paying that toll, Amazon's Graviton, Google's Axion, Microsoft's Cobalt, the cloud CPUs hyperscalers built to cut their own costs, all ARM-based too. So no matter who wins the compute war, GPUs, custom ASICs, or hyperscalers' own in-house chips, one company is collecting a piece of nearly all of it. Why bet on one side of that fight when you can own a slice of every side at once? And here's what that's actually worth right now. ARM's data center royalties more than doubled year over year last quarter, and the management's targeting $15 billion in chip revenue by 2031 as it pushes deeper into AI infrastructure directly. It's not cheap, the stock trades above 100 times forward earnings, but that's the trade you're making, paying up for the one name that gets paid regardless of who wins. And in the case of this stock, we are also looking at an initial 5-way move to the upside within this wave 1. It's not as apparent on the daily chart, but if you move on to the hourly chart, you will see how clear it actually is. However, smaller time frame means higher risk. This doesn't mean that it isn't a great opportunity, however, because from a large time frame perspective, the structure of this stock is suggesting even more strongly that it is ready to take off. It has seen a much more clear correction, a much more complete one. It has pushed into the last level of support, basically. It's like $1 above it. And we are looking at a structure that requires even more so than Nvidia that next leg up, that next extension higher. Then we expect the correction to reach the yellow area of support. It has actually done that, check. And we are looking at the invalidation to not happen, which means we do not want to see it break below the beginning of this entire wave 1 up. Yeah, we are looking at it to not break $219. And as it usually is with smaller cap stocks, the downside potential is greater. We are looking from the current levels at an over 20% drop until invalidation. Now, I could argue that it shouldn't even break the current lows if this wave 3 is to really take off, because this is supposed to be another wave 1 up, a very tiny one. But the potential is much greater as well. this stock would likely do at least a 2x from the current price point. More so the case from the wave 2 low, and if it even sees a reset within this yellow wave 2, we are looking at a structure that provides maybe the same 10% risk we might see on Nvidia, while allowing an over 2x to be had. And personally, I wouldn't even necessarily discount the probabilities compared to Nvidia that much or at all, to be honest. And none of this technology would actually work at all. The GPUs, the custom ASICs, the architecture toll ARM collects on all of it. None of it matters if the chips can talk to each other fast enough. Thousands of processors sitting in a data center are just very expensive space heaters unless they're wired together as one machine. That's the layer almost nobody covers, and it's the one where this goes next. This is where Credo comes in, the company that makes the literal wiring connecting GPUs inside the rack, what engineers call active electrical cables. But how does a cable company end up growing faster than almost anyone else in this space? Because it isn't selling just cables. Credo also licenses underlying chip design behind them, the SerDes technology, directly to hyperscalers building their own custom silicon. So when hyperscaler licenses Credo's design for their own ASIC, Credo becomes the natural default for the physical cables connecting the same chip too. One deal feeds the next, and the growth shows it. Full year revenue more than tripled from about $437 million to about $1.3 billion. Non-GAAP net income jumped more than 5 times to $662 million. Gross margins sit around 68%. That's the flywheel showing up in the numbers. Win the chip design, win the cable contract that follows it. Now, the honest risk here is concentration. The top 10 customers make up around 90% of the revenue, with 2 single customers each above 10%. If one of those relationships slows, Credo feels it more than a company with a broader base would. And it so happens that the risk shows up on the chart as well. The overall structure still points higher, but there's more short-term uncertainty here than in the other 2 names. That's the trade-off with a stock like this. It can move fast in both directions. A 4x from here is realistically on the table, and if this stock keeps running, Credo has more room left to move than almost anything else in this sector. Of note here, Credo has already built what can be tracked as a 3-wave correction, and from the lows it's rallied over 60%. Now, the thing is, it didn't manage to create a reliable pattern within a smaller time frame. I do not have 5 waves up here, but I do have what can be tracked as a series of 1-2 setups in the case of this stock. This means that as long as the current levels are still holding, as long as we see the next breakout, it is quite likely going to be a stronger move than we would see in either of the other 2 stocks. As I was saying, a 4x is quite realistic, is quite capable. Interestingly enough, this stock actually allows a much closer invalidation level than the other 2. We are looking at about 8 to 9% to be lost until this setup has been invalidated. The trade-off, the probability of this setup, may not be as promising. The larger time frame structure could easily allow this pattern to extend, could easily allow this wave 2 to see a reset, meaning that this could have been the wave B top, which pushed pretty much perfectly into structural resistance here, and we are looking at a wave C to take it to even lower prices. So the risk is real, but the potential is just as real. The benefit is that we know it must hold $237 for it to still be capable to follow this rally, for it to still be capable to follow this path. This wave 3 could be enormous, but this impulse depends on holding these levels. Technically, it could still build a larger wave 1, but right now I do not believe it is complete. I do not believe that we could look for a larger wave 2 correction just yet. So we have the chips, the architecture toll, the wiring holding it all together. That's most of the compute side of this story, and it's the part playing out right now. But zoom out further, and the build-out doesn't stop at the rack. Every one of these data centers still needs power to actually run. And that strain is already showing up in places most investors aren't even looking at. We've already covered some of the other spills from the same expansion into other sectors. It's the same money moving throughout the same build-out, and it's likely where more of it flows next. Here's the honest risk, and it's already happening in miniature. When Google raised its own capex guidance last month, its stock dropped 7% anyway and dragged Amazon, Meta, and Microsoft down with it. Investors weren't punishing them for spending too little. They were punishing them for spending record amounts without proof yet that it pays off. That's the real tension underneath this whole trade. Not whether the money keeps flowing, it clearly is, but whether the market keeps believing in it before the returns show up on paper. But you have to understand, the spending's already locked in. These companies didn't just raise guidance, they went out and raised the debt to fund it. Servers already ordered, contracts already signed. Nobody who's already sold the bonds cancels the build a quarter later. So the real risk isn't that this stops, it's that the market keeps flinching before the payoff shows up. The exact kind of flinch that wiped out $1.3 trillion in July. And my honest opinion, it will continue to flinch, but there will be breaks, significant ones. And if you're waiting for the headline to tell you that it's safe, you'll miss it because that headline never comes until after the move already happened. And if you want the full picture, this isn't the only piece of it. We already covered the grid rebuild and the nuclear fuel chain getting rebuilt, both getting pulled forward by the exact same build-out. Go watch those next if you haven't, and there's one more piece still coming very soon, so keep an eye out for that one too. And for now, these are the levels, this is the trade setup. I hope you enjoyed the video, and if you did, don't forget to check out the other pieces we covered that should show up on the screen right now. Don't forget to leave a like, subscribe, and if you enjoyed the content and want to support it directly, check out the channel membership, and I'll see you in the next one. Bye bye.